Is multifamily real estate a good investment? If you're just getting started learning about investing in real estate, this is a very good question to ask. And in this video, we'll be answering just that. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and answer the question, is multifamily a good investment? And when it comes to any real estate investment, I like to talk about three things. And the first thing is cash flow. Cash flow is the lifeblood of any real estate investment. We can be equity rich all day long, but if we don't have cash flow, the deal dies. And this is one of the strengths of multifamily compared to, let's say, a single family home or a duplex. You have a single family home, you're renting it out. The tenant moves out, your revenue goes from 100% to zero overnight. This is a huge problem. Imagine running a business, and in fact, we've had this with coronavirus that just obliterated entire sectors due to the shutdowns. Imagine having your revenue drop to zero overnight. Duplex, 50% of your revenue gone when a tenant moves out. Even a fourplex, 25%, a quarter of your revenue gone when you have a turnover in the unit. With multifamily real estate, the larger you go, the more stable it is. And the more cash flow you have. The reason is you have 100, 200 units, and that turnover is able to be absorbed because of the scale of the property. Another reason why we have the cash flow is the expense ratio per unit is significantly less than compared to a smaller property. You have the expenses spread over, let's say, 75 units, 150 units. Then you have full-time management that's able to be supported by the cash flow produced by this property. You have full-time maintenance staff. Your property management costs are less. If you have a single family home or a duplex or smaller plex property portfolio, you are paying much higher fees when it comes to property management. Plus, you don't have full-time staff on site. That property manager may be visiting maybe once every 2 months. With the large multifamily property, not only do you have the cash flow, but you have full-time staff on site all the time. There's a very strong argument that can be made in that the property is better managed and well run and is more efficient because you have staff on site all the time looking after it, as opposed to a property manager managing a couple plexes that you own, and then they're also looking after 100 other properties. It just doesn't compare. So cash flow, extremely strong. And when you're looking at investing, you want that cash flow coming in. You can't just be all equity because, like I said before, you can be equity rich, but the deal just dies under the weight of itself if you don't have cash flow to support the debt and also to support the investor payments, because investors want to receive their monthly or quarterly returns depending on how the deal is set up. The second thing I want to talk about is appreciation. Now, when I say appreciation, I don't mean hoping the market goes up. There is a big difference between forced appreciation and market appreciation. We are all professional real estate investors, or we aspire to be professional real estate investors. And the main thing professional real estate investors do is they control everything they are able to in a deal. We can't control the market, the greater market itself. We know that. That is speculating on future growth. We don't do that. That is not a prudent, conservative way of investing. What we can control, because of the large scale of multifamily real estate, we can control the valuation of the property. I'll put a link right up here to a video I did explaining everything about the income approach, which is how commercial multifamily real estate is valued. If we own a house on a street or a smaller residential property, and it's 3 bedrooms, 2 baths, and 4 other houses on that street or in the area sell for $500,000, well, guess what? Our house is worth $500,000 because it's valued differently. With commercial real estate, It's the property is valued based on the net operating income, the cash flow the property produces. This is why we can control the appreciation and the valuation of the property. We can acquire an asset with what we call a value add opportunity. And I'll put a link up here too to a video I did explaining more about value add if you're interested. So we can acquire this asset. We can do some renovations, improve management, reduce expenses. We can raise rents to market value if they were below market value. Everything is geared towards increasing the net operating income. What does that do? Well, we have controlled everything we've done on that property to increase the NOI, which in turn increases the property's valuation. We are forcing appreciation. We are controlling the valuation of the asset. And this is what I mean by appreciation. Forced appreciation rather than market appreciation, which we can't control. Obviously, we can do our due diligence on the markets. We can look for the key market drivers that impact market growth. And sure, everybody loves market growth, but we can't control it. Something could happen overnight, but what we can control and what professional investors look for is the forced appreciation aspect. And multifamily, because it's valued using the income approach, it is a huge advantage when it comes to investing in this asset. And last but certainly not least, in fact, this could even be number one, is stability. I don't care what type of investment it is, whether it's real estate, something else. Rule number one is preserve your capital, because if your initial investment disappears, then game over, you're done playing. You cannot recover. But if you can preserve your capital, if something goes wrong, then you can live to fight another day and recoup some of those losses. When it comes to large multifamily properties, it is incredibly stable. CBRE took a look at how multifamily performed against other commercial assets over the past 2 recessions, and multifamily was incredibly resilient. So if I'm an investor and I'm looking to place capital in an asset, I get my cash flow, yes. I get my appreciation, the control factor, yes. But most importantly, I'm placing my money in an incredibly stable asset. If I'm an investor placing my capital in a multifamily deal, stability is worth the price of admission alone. It is an incredibly stable asset, unlike some other alternative investments where the values swing wildly. Well, with multifamily real estate, I can rest easy. It is incredibly stable, so I know my money is secure, but I also get the benefits of the strong cash flow as well as the appreciation, the forced appreciation, the stuff that we can control, and then the market appreciation if it comes. As long as we choose the right market, it is like the extra wind on our sails to push the deal ahead. Now let's talk about some alternatives we have to multifamily real estate. Well, we can invest in GICs. The only guaranteed thing about GICs is that you're guaranteed to lose money. Let's say you're able to pick up a 5-year GIC at 1.4% right now. What's inflation on an annual basis? 2%, let's say, if not more. So right off the bat, we're losing money guaranteed to inflation. I don't know how you can call this an investment. It's a guaranteed loss vehicle. They should change the name. We should call it a guaranteed loss vehicle, GLV. I've just renamed it, guaranteed loss vehicle, because you're losing money guaranteed. I don't understand why somebody would put $200,000 or $300,000 in a 5-year GIC when instead you can invest in a multifamily asset. You get the incredible stability, you get the appreciation, and you also get the cash flow. And you get returns that are well in excess of 1.4%, which is nothing. We also have mutual funds. And then we have stocks. And then we have bonds. So with mutual fund stocks, we can't control the stock market. That is speculating, hoping that the market goes up. Just like the real estate market, we can't control it. Yes, we know that the market goes up over time, but we cannot control it. We need to focus on what we can control and control as much as we can in the deal. This is why we have the strength of forced appreciation in multifamily real estate. If I buy a stock in a company, I am just one little small fish. I do not control the company. I cannot change the direction of the company. I cannot change the market like I can with multifamily real estate, with how I can implement a value add plan and really drive that NOI up so I can in turn increase the value of my asset. I can't do that with stocks. I can't do that with a mutual fund. I certainly can't do that with GLVs, guaranteed loss vehicles. With all of these investments here, we don't get to take advantage of the most important thing, or one of the most important things, is tax benefits, like we do with real estate. The government in the tax code gives real estate investors a leg up. It's called depreciation. So what happens is we are able to depreciate our asset. We are able to take a paper loss on day one that reduces significantly our tax liability for all the money that we're going to make in the deal. So we have the strong cash flow, we have the appreciation, we have the stability. Our money is being put hard to work in these deals. We are making a significant return, but then we're able to use the tax code to our advantage and pay a whole lot less tax. Yes, everybody should pay the tax they owe, that's true, but we also have to take advantage of the tax code and use it for its intended purpose. The government wants us to invest in real estate. They want us to improve properties, and this is why we get rewarded as investors in the form of tax credits through depreciation and cost segregation studies, which is the topic of a whole nother video. You just don't get that with mutual funds. Plus, with real estate, it's a passive investment, so we're already paying less tax through it being a capital gain. And then we have all the depreciation on top. But sure, multifamily real estate has cash flow, the appreciation, the stability, and the tax benefits. I feel that it is far better than all of these investments over here. But I don't want you to focus on all of these things right here. Instead, I want you to focus on three questions. Who, what, and how. We just made a whole bunch of blanket statements about multifamily real estate, but these are the important questions. Who is running the deal? What is the opportunity in the deal, and how is the team going to make that happen? If you are working with the wrong person, these things don't happen because the person will mismanage the deal. What is the opportunity? If you don't have a good opportunity in the deal, these things won't happen. How is the team going to put this into place? If you don't have a solid business plan, these things won't happen. So instead of focusing on all of these things, I want you to ask yourself these questions: who, what, and how. Who's managing the deal? What is the opportunity? And how are they going to make it happen? We already know how great multifamily real estate is. But I want you, as an investor looking at opportunities, ask these questions instead. These are more important because these are a given. We already know with a great deal, even with a good deal, all of these things will come. But in order to find those good and great deals, you have to ask what really matters, which is who, what, and how. If you want to learn more about multifamily investing, join our free Facebook group. I'll put a link right down there below. We have lots of great people involved. And if you are an accredited investor and you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found it useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel and I do appreciate it. And until next time, happy investing.